I'm Jason Stipp from Morningstar. In this yield-starved environment, a lot of bond investors are probably looking outside their core portfolios to see where they might be able to pick up a little bit of extra yield. Here with me to talk about some of their options and what role they should play in a portfolio is Morningstar's Christine Benz. She's Director of Personal Finance for Morningstar.com. Thanks for joining me, Christine.
Jason, nice to be here.
So I think a good area to start when you're thinking outside the core of your bond portfolio is in high yield. A lot of core funds won't hold, or index funds won't hold high yield. Does that mean that investors probably shouldn't hold them, or how should they think about high yield then if they're not part of the core?
I don't think of it as an essential element of investors' fixed income portfolios, and to the extent that they hold high yield, they're probably better off thinking of it more in the equity sleeve, because the performance that you'll see will tend to be more correlated with the equity markets than with the bond market. So think of it as an aggressive kicker to a portfolio, and definitely try to keep a lid on how much you hold there. Even though yields might look appreciably higher, we usually say in the realm of 5 or 10% is fine for most investors, if not less than that, because of the extra volatility.
Okay, another area that we've been hearing from readers are bank loan funds, and these look attractive, especially because they'll float up and down with interest rates. And if people think interest rates are going to go up, they might think that this is an attractive investment. What role should this play? Are there any risks to them, or are they even a good idea?
Well, it depends on how you're using it. Again, this is a piece of a portfolio that I would think of for the aggressive kicker sleeve, not the core sleeve. And the risk that a lot of investors fell into earlier in this decade was that they were using them as a money market substitute. And the risk profile is completely different. These things can be really quite junky. Not all of them are, but most of these loans are lower quality, or many of them are. So they're very economically sensitive. They will tend to perform a lot like junk bonds in that respect, and that their performance will ebb and flow with the economy. So you want to keep them to a small sleeve of the portfolio, and by no stretch of the imagination should you think about using them as a cash substitute because of the major fluctuations in principal value that you'll see with them.
Sure. Another area that's been on investors' minds a lot is overseas and foreign bonds. And, I think a lot of investors like the idea of the diversification, but since Greece and the European woes are probably a little bit more skittish. So how should you think about the European or overseas portion of your bond portfolio and how much that should take up?
I think it depends on where you are in your life. So for younger people who have a component of their portfolio in fixed income, I would look to foreign bonds and foreign bond funds as another source of diversification. So you pick up that foreign currency diversification. But the risk is that as you get older and further along and need to be tapping that portfolio for income, you have a big element of foreign currency risk that doesn't really need to be there. So I would step that foreign bond weighting down as the retiree or as a person gets closer to retirement because of that foreign currency risk.
Okay, and lastly, another area that a lot of investors have been writing to us about is TIPS, and these are bonds that will adjust according to the CPI or the inflation rate. A lot of folks think of these also as satellite holdings, but you would argue that maybe they're a little bit more core than satellite. Why is that?
I would, and they do not appear as a component in major total bond market indexes, but I think of them very much as a core, particularly for retirees and pre-retirees. And the key reason is that as people like that are deriving more of their income from fixed rate investments, they're not seeing a real increase in their purchasing power. And if inflation goes up, they may in fact see depreciating purchasing power. So holding a sleeve of your portfolio in TIPS helps you keep up with price increases for stuff that you need to buy. So I often look to Ibbitson's work to help inform what's an appropriate allocation. And for retirees, something in the neighborhood of 30% of the fixed income portfolio might be appropriately stashed in TIPS. I think that makes a lot of sense, actually, as a strategy.
Sure, Christine, thanks for the ideas and for the survey of these core and satellite fixed income investments.
Thank you, Jason.
From Morningstar, I'm Jason Stipp. Thanks for watching.